All right, would you rather gamble in Las Vegas or would you rather own the casino? In this video, I want to talk to you about how to start investing in stocks for beginners. I'm going to talk about the difference between gambling and investing and when to buy stocks and to when to not buy stocks. So last week we had the Super Bowl. We had tons of people who gambled on who would win. The week before that, we had a Wall Street bros or Wall Street bets who not only bet against billion-dollar hedge funds, but they actually had a short-lived victory. But in the end, they actually created billions of unknown winnings for other hedge funds. They lost a lot of money for their followers and other non-investors who bought in high and sold when it dropped or didn't sell. And lost the money that they could have turned into profit. So, guys, that is like suiting up against the Tampa Bay Bucaneers and thinking you're going to win. I mean, these guys, these hedge fund guys, they eat, sleep, and breathe finances. So to try to go against them is just really not a smart idea. Buying one stock is like gambling on a winner. But versus buying an ETF is like owning the casino. So the thing is, guys, is true investing involves all the fun of economics, finance, math, and reading reports. And if that doesn't sound fun to you, then you probably shouldn't buy individual stocks. Because like I said, these finance guys, these hedge fund billionaires, they just immerse themselves in reading reports. Warren Buffett is known for reading, I think, like 8 to 10 hours a day. He just reads reports. And if you don't know who Warren Buffett is, you probably shouldn't be buying stocks. Warren Buffett is one of the top investors. He's a multi-billionaire. He's constantly towards the top of wealthiest people in the world. But he believes that most investors or non-investors specifically should just put their money in an ETF. And if you don't know what an ETF is, you definitely shouldn't be investing in individual stocks. Basically, an ETF is electronically trended. I always say that word. I always say it wrong, so I always don't even bother saying it. But Google ETF, and I always say EFT. I mess it up. So obviously, I'm not a professional speaker. I'm not a professional finance advisor. I'm actually just trying to help people any way I can, and I'll talk to you more about that, how I can help you specifically. So Benjamin Graham actually wrote The Intelligent Investor. He was actually a mentor of Warren Buffett, but he believes that you should study stocks for 1 year before you actually buy stocks. Now, I actually just finished reading The Intelligent Investor, or actually listening to an audiobook. I try to read it through. This is my third time. I tried to read it twice before. The first time, I literally read like maybe 2 or 3 chapters because I kept Googling what everything meant, because I was like, okay, what does this mean? I want to make sure I fully understand everything I'm reading, and it just took forever. It took me probably like a month to read those 2 or 3 chapters. So the second time, I'm just going to read it straight through and just see what happens. And same thing, it took me about a month to read maybe half of it. This time, I just said, all right, I'm just going to listen to it all the way through and just see what my brain absorbs. And even that took like a week or two just to listen to the whole book, because there was just so much content, that was so much information for my brain to soak in. I would literally listen to one chapter at a time and try to absorb, like analyze what I learned in that audio book. And the next person is Ray Dalio. He is another hedge fund billionaire. I think his hedge fund's called Bridgewater, and he has what's called an any weather portfolio, which Tony Robbins talks about and other people have talked about, where he says only 30% of your total investment should be in stocks. He has it diversified into other stuff like real estate and things like that, gold, bonds. So if you don't have any of those other things, you should not buy individual stocks. If you don't have 1 year to study stocks and really analyze them, read their financial reports, read their prospectus, understand everything about their business, do not buy individual stocks as an investment. If you want to gamble, go right ahead. I mean, I'm not stopping you from gambling, but just don't look at it as an investment. It's gambling. If you want to do it for fun, go right ahead. But I do want to help you get started. And the easiest way I found to start investing and to start saving money has actually been through Acorns. If you saw one of my previous videos, I talk about how I really just put $50 a month into my Acorns account, and then they have all these other rewards, and they round up your spending, and so that $50 a month actually turned into $1,000, which I was actually shocked because I don't even think it was a full year. And guys, right now I think it's like 75 to 80% of Americans don't have $1,000 if an emergency were to happen. And I sell insurance, and I might have said that earlier. I was going to say it, and then I got sidetracked. So for me, I always was like, I don't need that much money saved up, because I'm an insurance agent. I have pretty protection. I have life insurance. If something happens to me, I'm good. But after the year we had in 2020, guys, we all need to have some backup money. We need a savings account. We need something. And that's what I liked about Acorns, is it really helps you. It helps gamify saving money. It makes it super, super simple to save money. So now I have last year I didn't even have any goals. I was just like, whatever, I'll open this account and see what happens. And then now I have much bigger goals for actually saving money. That way I can, start doing something good with it, like instead of what I was doing in the past, which was nothing. I was basically, anytime I had extra money, I'd take a vacation, I'd buy stuff, just the stupid stuff we all do as humans, which is fun and what makes it fun to be a human, but it's not always smart when you in a global pandemic. So I definitely learned my lesson, never doing that again. But like I said, what I like about Acorns is they also give you rewards. That if you buy from their partnership products, like when I got like Disney Plus for a month, I got like $7 or $5, whatever. They have like one with Walmart. They have a bunch of other partnerships where if you just buy stuff you were already going to buy, they give you like $5 to $10, something like that. So like I said, I think I got like $40 from them just from buying from their partner products. So the cool thing too is they give you your first $5 for free. And then they also give you $5 when somebody else joins. So if you join off of my link, I get $5, you get $5. If you share this on your Facebook, they get $5, you get $5. So I think I got another 20, 30, 40 bucks off of that. Not a ton of money, but it's free money. That's why I looked at it. Another easy way I found to start investing is actually through Robinhood. They were in the news a lot. They were part of that big fiasco, mainly because they make it so easy to buy and sell stocks, and that's what I liked about it. And then also too, they put your money into, they ask you a couple questions about your risk level, and Acorns does this too when you first start. They give you like, where do you want us to put your money? And so they ask you a couple questions, and that way you know what your risk level is, you know what you want to do with your money. And that's kind of what I like about Acorns and Robinhood. They make it just really simple to start selling stocks. And same thing, like I said, I got a couple free shares from them, and you'll get a free share if you join through my link, and I'll get a free share. And same thing, I put in like $100 and got some free shares for that. I think, I don't remember exactly. And then you're able to buy and sell really easily. That's what I like about it. So definitely check them out. And actually the newest way, I'm still learning about it. I don't know all the ins and outs. I literally downloaded the app like a month ago. It was with Webull, and then it took them like a week to verify my deal. Then it took another week to accept my money. So I literally like 2, maybe 3 days ago, finally was able to put my first like $100 in an ETF. But same thing, they give you like 2 free stocks, and then and that was the kind of the clincher. Like I was like, I guess I'll go ahead and download it. I get 2 free shares, and so I got 2 free shares. And then when I was just deciding if I should put my money into Acorns, and like I said, I'm rebuilding my savings again, or my safety fund, or whatever you want to call it, just extra cash that I don't have it's not in my checking account, it's not in my savings account. And guys, your savings account is probably garbage. You're probably getting like more than likely less than 0.25%, maybe 0.5% if you're lucky. So don't put it in your savings account. Put it in Acorns. Put it in an ETF. Put it somewhere where it's going to potentially grow money. And that's the only downside of putting an ETF. There is a potential for loss, but it's spread out so wide. Your potential for gain is so much higher. I mean, in order for you to lose money, basically the economy has to lose money. And if that's the case, then so be it. But at least if the economy is growing, you might grow 3 to 5%. I think mine only grew maybe 7% in the year. I think that's what it was, like 6 or 7%. But like I said, they have all these other ways for you to put money into your own account. So it's not like free money. I mean, it is in some ways, but you're not going to double your money overnight, but you're also never going to lose all your money or things like that. And if you've heard stories about, I'm listening to, like I said, the Intelligent Investor, they're talking about like all these stocks that lost all their money overnight. And that's the thing, guys. If you have an individual stock and let's say I saw a meme that said this the other day about Circuit City. Like, imagine if you would have had your money in Circuit City when they had to file bankruptcy, or Toys.com. I think that's what they talk about in The Intelligent Investor. What if you would have had your money in Toys.com because you thought they were going to replace Toys R Us? Or what if you would have had your money in Toys R Us, when thinking that they're going to be the next blah, blah, blah. So guys, it's so hard to predict the stupidity of people. There's always a chance that a certain company can make mistakes, and it talks about all these. You definitely need to listen to that book, if nothing else, The Intelligent Investor. It talks about so many situations where companies just made stupid mistakes and lost a lot of money. So definitely, guys, I can't say this enough. Start with an ETF. That way you can have less risk in that. So, and that's what I want to talk about next. Is if you have $0 to $1,000, I would start with Acorns. That way you're building up your money. If you have, it's happening automatically. It's coming out of your account or your bank, your paycheck, whatever's easiest for you to set up. It happens automatically. You're growing that account. Once you get to 1,000, I would just leave it there. I mean, whatever your magic number is, like I said, the risk is much lower than the potential for growth. So I would just leave it there until you have, whatever your next goal is. If you're trying to reach 5,000 or 10,000, or if you're trying to buy a house, just leave it there. Just keep building it over time. If you do want to start investing, buying individual stocks, I definitely, figure out what your risk level is. If you say, look, I can lose half my money and I would still be okay, then only invest half of your money and leave the rest in an ETF. Does that make sense? So like, if you're like, if I lose any money, I would be devastated, then leave it in an ETF. And like I said earlier, guys, I'm an insurance agent. I do have access to some safe insurance vehicles you can use where you won't lose money. Obviously, there's a cost, and that's the difference, guys. The cost of insurance is higher, but the risk is zero, pretty much. Whereas with stocks, obviously most stocks have a zero commission trading. That's what everyone's selling now, like Robinhood and Webull is zero commission trading, but the risk is so high. With ETF, obviously the cost is still low, but your risk is much lower, but also your potential for gain too is lower. But like I said, 6% is much better, or 4% or 8% or 12% is much higher than what your CDs or your savings account is going to offer you. So guys, I hope you enjoyed this video. Hope it helped you. And like I said, I'll provide a link if you want to schedule time with me to talk about what insurance products may work for you. I'll leave a link in that too. So thanks for watching, guys. Bye.